Hi, everyone. Mark Sorensen, Chief Investment Officer at Royal Fund Management. We recently put out a video concerning the recent volatility due to the banking crisis. This time, we thought we'd take this opportunity to give our first quarter market commentary overview in video format. First of all, the S&P 500 was up 7.5% in the first quarter. So at least a bit of a sigh of relief after a very tumultuous 2022, right? But today we're going to talk about the market, and we're going to give you our thoughts about inflation, the Fed, the interest rate cycle. But first, I'd like to start with some interesting statistics that I reviewed lately that made me feel a little better about the future, and I think it will you too. Let me share my screen. First of all, as I said, the S&P was up over 7% in the first quarter of 2023, but it's the second straight quarter that we've had at least a 5% gain. Since World War II, there's only been 25 other times where we had back-to-back quarters with at least a 5% gain. Over the next two quarters, in other words, over the next 6 months, the median gain for the market was 8.2%, and it was positive 23 times out of the 25. That's about a 92% positive rate, which of course, I think is a good bet, right? Another quote that I wanted to share with you is this one, and that is, since World War II, when the S&P has posted a gain in the first quarter, and as I just mentioned, the S&P was up about 7.5%, it has averaged about 8.9% the rest of the year. When the S&P, in contrast, was down in the first quarter, the rest of the year averaged only about 2.6%. I put it in bold because this is important to point out. In the 10 years that the first quarter gain was following a down year, the average rest of the year gain for the S&P 500 was 15.9%, and it was up 100% of the time. Every year all of those 10 years where we had a gain in the first quarter following a down year, all 10 years the market was up and averaged 15.9%. Because we've talked about the banking crisis, some have worried about whether it's similar to the financial crisis we had back in 2007, 8, and 9. I would argue that it's very dissimilar. In fact, the reasons why the bank reserves back in 2007, 8, and 9, the banks couldn't even determine their value. Very derivative portfolios, credit default swaps, and things that we didn't even know about until after that happened. Now, the banking reserves are nearly 100% backed by the full faith and credit of the U.S. Treasury. So there's no credit risk in banking reserves. The problem has been a mismatch between short-term deposit rates that banks have to pay and reserves that are in longer-term treasuries. So when interest rates went up, the value of those treasuries went down. But there's not the credit risk there was back in 2007 and 8. There's no question about the quality of the reserves, and the government and the Fed did a good job of stepping in and backstopping the Silicon Valley Bank crisis so that we didn't have further contagion. But let's look back actually to that time frame in terms of the market. Another interesting statistic. Even if you bought the S&P 500 if you bought the S&P 500 at the very bottom of the financial crisis back in March 9th of 09, number one, that was 14 years ago. You'd have been one of the luckiest person alive, right, to buy at the bottom. But if you did, the market would have averaged 15.8% a year. So I think it's even a more interesting statistic to say, what if you were the most unlucky person in the world and bought at the absolute high before the financial crisis? The absolute high of the market before the financial crisis in 2007, 8, and early 2009, the absolute high was October 9th of 2007. Even if you'd have bought at the absolute high and had the wherewithal to stay with it, you would have still averaged through March 9th this year 8.4% a year, which in fact is about 3 percentage points above the Treasury yield curve. In other words, bonds. You'd have still done about 3% better than if you put your money in bonds, even if you bought at the absolute high of the market. Why is this an important point? Because most of you have done a tremendous job, as we've talked about over the last year, of thinking with your head and not your heart. You've been able to know that time heals all wounds, that timing the market's a zero-sum game. It's time in the market, not timing the market, is the old cliche. And so now you're starting to reap some rewards as we're closer to the end of this bear market, and the markets look like they're going to be doing better, and I'll talk more about that momentarily. So really interesting to know that if you're a long-term investor, even if you bought at the high back in October of 2007, you would have still averaged 8.4% through March of this year. Another interesting statistic that I wanted to show is this one. Give me a second to put it on my screen. The last 7 times the Fed has stopped raising interest rates, meaning that they were in a tightening cycle. They were raising interest rates to try to calm inflation, but they eventually stopped, right? We don't know if they've stopped yet, but most people feel like we're very near the end. We may get another 0.25% rate hike at the May meeting. We may not, depending on the data that comes out between now and then. But we're close. But the interesting statistic is the last 7 times that the Fed was raising interest rates and then they subsequently stopped raising interest rates, the market averaged about 12% a year. So we'll know soon. We'll get the next Federal Open Market Committee, where they determine whether they hike interest rates or not, is the early part of May. And at that time, we'll see whether they go up another quarter or start to talk more dovish and say it's time to pause and wait to see how the economy does going forward. But we are close to the end of the tightening cycle. And the last 7 times, that meant the market went higher, an average of about 12% over the next year or so. Another very interesting statistic that I just got over the last couple of days is that we recently had the market moving up, and over 90%, in fact, 93% of stocks were above their 10-day moving average. What does that mean? It just simply means if you average where the stock had been over the last 10 days, the stock currently was higher than that 10-day average. And historically, when 90% or more of stocks are above their 10-day moving average, this is sometimes called a buying thrust. The risk on trade is back, so to speak. A year later, 23 out of 24 times was the market up when this happened, and it averaged 18.5%. I'm not recommending or suggesting that the market's going to be up 18.5% over the next year, but based on that data, based on the presidential cycle, the fact that the market usually does well in the third fiscal year of a presidential cycle that we're in now, all of those things lead to an expectation that the market likely will do better over the next year. Now, to talk about the market specifically, let's look at it from a technical standpoint. One of the things that I've said over the last several calls is that since the October low last year, we've been able to establish a really nice technical pattern for the market. And by this, I mean that we've had higher lows and higher highs since the lows last October. That simply means that off the lows, the market went up. When it came down, it set a higher low. Then it made a higher high, another higher low, another higher high, another higher low recently. And now we are trying to make a new high on the S&P 500 again. If I put up the chart of the NASDAQ 100, I mentioned that the growth, the risk-on trade is back. You'll notice that the NASDAQ stocks, the little higher beta, higher risk stocks, have already made a new high in the current pattern. In fact, if we look at this chart, it shows, as I've said before, that the S&P 500 in the first quarter was up 7.46%, but the NASDAQ 100, as represented in this chart by the QQQ, was up 20.71%, almost triple the performance of the S&P 500. There's only one reason why this is important, and that is that risk on is back. Money is flowing back to the market. That is evidenced by growth starting to outperform value again. And that's just another good sign of better things to come. Next, I want to talk about kind of the tug of war between commentators you hear talk on TV when you watch the news. The question is recession or not? The market seems to be telling us something different. The market is telling us, as a leading indicator, that the economy is strong enough to withstand the higher interest rates without going into a recession. There are a lot of people calling for recession and saying that the market has to try to go down again, and that might very well happen. But if that does, I would argue that that would be one of the better buying points of a lifetime, because that's where the next bull market is usually spawned from. However, here are some statistics as to why we think the likelihood is that if we have a recession, it would be very mild, and we think the market can be resilient, and that's what the market has been telling us of late. First of all, we came from a very strong economic point at the time this bear market started. When they started raising interest rates, the economy was very strong. So we already had a bit of a cushion to work with. In addition to that, the market has continued to be very resilient as we've seen inflation start to come down. For example, just yesterday, the announcement came out of what's called the CPI, or the Consumer Price Index, which is a measure of inflation at the consumer level. The month-over-month reading came at 0.1 when the market was expecting 0.2. So it came in at half what was expected. If you extrapolate 0.1 over a year, that would be an annual inflation rate of only 1.2%, right? Well, obviously it doesn't go in a straight line, but it's very positive news. The other thing, which I think is even more positive, is the annual year-over-year level for the Consumer Price Index came in at 5%. The market was expecting 5.1, so it was better. But that's not what I think is important. What I think is important is not to look at what was expected versus where it came in, but to look at how much it actually came down since last month. Last month's CPI reading was 6%. The expectation was 5.1, but last month's reading was actually 6%. So the 5% reading yesterday was actually a full 1 percentage point lower in just 1 month. So that we think is a very good sign. Today, we got the Producer Price Index, which is inflation at the producer level. The expectation was 0.1. It actually came, ready for this, at negative 0.5. It actually contracted. In fact, that's 2 negative months for month-over-month producer price index in a row. The annual year-over-year rate was up on an average year-over-year of only 2.79%, meaning the year-over-year inflation rating at the producer level was only 2.79%, meaning we are definitely seeing inflation come down. So where do we go from here? We're in earnings season. A lot of people think that corporate earnings have to come down. We are in a bit of an earnings recession, but I would argue that the expectations of the market usually overdoes it in terms of negatively or negative thinking about it, so to speak. And so we think that expectations are lower than expected. We think the fact that the dollar has declined will help earnings for the major multinational companies. And we think earnings will likely come in better than expected overall. Are earnings down? Yes. We're in a bit of an earnings recession, but the market typically starts to look past that because when you're in an earnings recession, the market looks to when the earnings growth starts to take off again as a leading market indicator. In terms of what the Fed does, we don't have a crystal ball, but we do believe that the Fed tightening cycle is near the end. We've talked about in previous market commentary videos that the average bear market is down 30 some odd percent. We got down about 25% on the S&P at the lows. However, the average duration of a bear market is about 1.2 years, and that's about the time we're at now in terms of the length of the bear market. So things are looking promising. I would argue that there's still going to be volatility. There's going to be potentially some scary moments, maybe even over the next 3 to 6 months. But we think the picture is improving. The risk on trade is back. We do believe that the market, as a leading indicator, will look past the Fed tightening cycle that we're in to when earnings start to recover again. And over the next year, like a lot of the statistics that I showed you have proven historically, we think there are better times to come. I appreciate your patience. It's been a long 15 months or so, but we do think signs are getting better and better as the calendar turns. And time always heals all wounds. Appreciate your patience, and we completely believe that time and patience will continue to be rewarded. Until next time, thank you so much.